Hey, Mike, how are you?
Hello, I'm good.
Give me 1 second. I think I gotta switch my audio here.
No worries. I'm actually bringing up a few things myself here.
All right, I am good.
Um, what a difference a week makes.
Yeah. I think futures is calling out cash, or at least trying to.
Um, yeah, and I got one more thing to pull up for my part of the show. There we go. All right, I think I'm set. Here we go. Here we go. Here we go. You got to share your screen there, my friend,
All right, that's
Mr. Seahorse. That's quite the
you like
shirt you
that.
got.
I'm a big fan of Bill Murray's got a line of clothing, like golf clothing / clothing, and he's got some good stuff. So that's my tip of the day. Go check out William Murray clothing.
Really?
Yeah, it's cool stuff. And he
So what?
donates a lot of it to the profits to charity. So
That's really cool. It's fun here. Here in Chicago, we'll go to Second City from time to time.
yeah,
That's where he's kind of got started, or when he was very young. It's
yeah, no, he's still just as popular as ever. He'll show up at random weddings and just random events all over the country.
that's so fun. So speaking of showing up at random places, the state of Illinois has a nice history of our governors going to jail. With our recent Blagojevich was put to.
Yeah.
My wife found a video clip of him at a wedding singing Jailhouse Rock. Evidently, he likes Elvis and likes to do karaoke kind of singing things. So
Is this before or after he went to jail?
it's afterward, like
Yeah.
recently. They
Oh,
paid,
okay. So he's
paid
got.
him to show up at an event and sing Jailhouse Rock.
Oh, wow. Well, hey, know what you're good at, right?
Kind of pathetic, but all right, let's get her going. I'm gonna share your screen. Hello, everyone. Welcome, August 23rd, 2022. It is Greg Kuda, Mike Wisniewski, Materials Exchange, and the StoneX Westline Capital Management Crew doing lumber
Hello.
futures from the free seats. Greg, what do you know this week? What is going on?
Well, I mean, the obvious thing is that lumber futures have experienced a big sell-off the last 3.5 days here, where I think at the very least, cash probably flatlined as far as the appreciation higher. And as soon as we lost that upward momentum in futures, it apparently became a lot easier to fill the void back to the downside and then continue pushing higher, especially, the justification for having futures at a premium to cash just wasn't there. So back to reality, and we'll kind of go through the basis charts and kind of the opportunities that have set up. But let me get this going. Let's jump into, we'll start big and then work our way into housing and lumber. Um, I think the big thing week over week, Mike, that stands out to me is that equities have put in a high. Um, the S&P got up into the 4330 area. Can you hear me?
Oh no, something you just your mic went out. We're hearing you on a muffled mic, so it must have switched on you. All right, that's that.
How's that now?
No, it's still on that muffled mic, so it's probably not your headphone mic. You might have to change it on the program itself. It might have switched. So you see where the gear icon is settings,
Yeah, I'm looking at that now.
audio, and whatever your audio input is.
Is that any better?
Perfect. That's it.
Yeah, it switched on me. So sorry. Um,
We're talking equities
yeah,
here.
equities have topped out. S&P got up to 4330. We're 4136 last. The Dow got up to 32,000. I'm sorry, 34,246. It's back sub 33,000 now. And one of the big catalysts for this is that when you look at last week, the 10-year note was in that 2.8 area. We spiked back above, and we're currently in that 3% area. So you've started to see, and I think we have Jackson Hole this week where the Fed will speak. So we're going to see how much inflation is still on the forefront here, and as far as kind of dictating what they're going to do interest rate wise. But I think the market kind of started to fixate more on less fixation on earnings beating forecast and the reality of what lies ahead concerning inflation and interest rates, where the Fed is unlikely going to stop until they truly see signs of inflation abating. And you'll see in some of these slides that we have here that I think it's going to be easier said than done. So when we dive into here's the S&P, and this is as of last Tuesday. Again, we were up in that 4290 area. We ended up spiking up to 4330 last Tuesday afternoon, last Wednesday. Uh, Kind of you were up in that 19.1, 19.2% correction as far as the high from last week. And then fast forward to this week, we've had a sizable sell off now. You've rolled under the 9-day moving average. And if you just do some simple Fibonacci retracements, yeah, you could easily pull back into this 4065 to 3900 area on the S&P, and that would be a healthy correction after rallying close to 19% off the recent lows. The one thing that I thought was interesting, Bloomberg put this out, and yet Ed Yardini Research put this out that even so what you're looking at here, bear market rallies. This is the Nasdaq back in 1999. Everybody remembers the dot-com tech bubble. Even in a market where you had this on a macro type chart, on a big picture type chart, you had this massive rolling over of equities uh, um, going into a recession in 2002. You still had these sizable corrective moves of plus 20%, um, even in a bear market structure. So, kind of the analysis out there this week, is this the beginning of a new bull market, or is this just a dead cat bounce, a bear market rally? So, here's the NASDAQ on this current move. You can see we got almost a 25% correction off of the lows, and technically you can see the Bollinger Band high, the 50-day, the 44-day. This is the 62% correction on this move. So technically the market should fail. And what will be interesting from an equity standpoint is, do you go back and retest the lows? Do you get that scenario of lower lows, lower highs if we're truly in a bear market, or are we just going to go sideways to put in a saucer type bottom? To be determined. I think the other thing of interest is, magically how we've rallied here with fall ahead of us. Well, it'll be interesting to see what kind of stability exists in equities in all markets going into November, knowing that this is an election year, and a lot is at stake, especially on a national level with Senate, House, the swinging from one side to the other. So lots of volatility, and so kind of working into commodities. The other big thing that stands out week over week is that the U.S. dollar bottomed. It continues to trend higher, but amazingly, even with the higher dollar, crude oil has been able to bottom, and you can see it made a secondary bottom here and is bouncing and is up another $3, where crude oil seems more fixated on supply concerns, what lies ahead for Europe, more so than demand in China and just aggregate global demand. And then the same thing with wheat, same thing with copper. Gold is actually bottomed today, where you're seeing signs, and obviously lumber's bottomed off of the sell off from the last couple of days where lumber has been as high as $30. We're up $20 today. But you can see, you finally detached a little bit anyway from the dollar versus influencing a stronger dollar, influencing a negative commodity structure where commodities, at least for the last week, have kind of ignored the appreciation in the dollar and have also started to trend higher.
And I just definitely want to point out time of the year. This is the slowest trading. These are the absolute summer markets between now and Labor Day. So the moves get exasperated or just bigger than what you might anticipate or smaller than you would anticipate just because just lack of participation.
I think outside of December, this is probably the biggest holiday month for hedge funds as far as the hedge fund crowd is usually gone for the month of August. So you look at the last 5 days, crude oil, corn, nat gas, even S&P volatility is back with the big sell-off in equities here. So you're seeing physical commodities, the obvious ones here, along with the U.S. dollar. And to me, this is the most interesting thing, is that the dollar's up almost 2% before today's sell-off. And even with the strengthening dollar, you still have strength in underlying commodities. And then as far as the laggards, equities have kind of taken it on the chin this past, three days, basically since last Thursday. And then the obvious one before today was the big sell-off in lumber, where, again, this is as of yesterday's close. So as of yesterday's close, week over week, lumber was down just under 12%. So, before we shift into housing, the one thing, the headline that came out yesterday that I think caught everybody's eye, it was all over LinkedIn and, Bloomberg, CNBC, UK inflation to hit 18.6% next year, according to Citi. Investment bank raises forecast as wholesale gas prices surge. And I thought this is actually an interactive. I just took a snapshot of this, but this is pretty neat. But this just kind of lays out what inflation means to Germany, to the UK, to anybody that's heavily dependent on Russian natural gas. Just the average gas bill, October 1st of 2021. Last year, your average gas bill in euros was just under 80 euros. Look at your average gas bill this coming year, a year later. This is just staggering. I mean, this is a lot of money to just magically absorb from an economy standpoint. Pick a European country. This is what lies ahead, where wars have been started for a lot less, and it's just kind of interesting to see how Russia plays this, as far as, do they shut down the pipelines at the most critical time point? And it's going to have a devastating, or has the potential to really have a devastating impact, and kind of let this play out, where you get some staggering geopolitical driven inflationary type numbers as a result.
I mean, that requires straight up lifestyle change.
Yeah.
Like, you have to consume less energy, be it electricity that's made from gas, heat. It's you have to, not have to, but you might actually have to just change your lifestyle to accommodate for the new price.
And again, this is a country that's a first world country. Imagine some of the countries that are relying on natural gas, third world countries, some developing economy type countries, where this could become 2/3 of your potential income, or greater, as far as your food and energy type consumption. So this is something to really watch, and the trickle down effect everywhere else.
So what you're saying is we should buy stock in, like, North Face and Patagonia, because everyone can be wearing jackets indoors.
Right. Definitely have access to firewood, that's for sure. So now we'll jump into housing, Mike. This was from last week, but home purchase mortgage applications for the U.S. You can see off of just the beginning, from the peak back in 2021, and then this is the beginning of 2022. you're almost back to kind of the onset of the pandemic in March of 2020. So you've had a staggering decrease in applications for new mortgages. And then this kind of surfaces, I don't know how well, I'm sorry I couldn't get this clearer, but this was US July existing home sales, and it's broken down by region. And I know this is difficult to see, but this is basically northeast, Midwest, Southwest. Kind of gives you kind of where the growth is. And you can see that you've had a massive slackening of year-over-year existing home sales, but home price is still at or near all-time highs. So you're not seeing this big pullback yet in existing home prices, but you're seeing obviously a significant pullback in existing home demand. And to kind of break this out geographically, this next chart I thought, which was really interesting. So if you're a jobber, if you're a home builder on a national scale, it doesn't take much to figure out, looking at this chart, where the organic growth is going to be and where it's not going to be. This is job growth compared to March 2020. So, as we've come out of the pandemic and there's been a labor shortage, not everybody's a net winner here, where a lot of states have taken it on the chin relative to being down south to Texas. You've had this big migration out of Washington, out of Oregon, out of California into Idaho has been a big beneficiary, Montana, Utah. You could make the case that this has everything to do with the political climate, taxes, all of the above. But if I'm looking where the growth is going to come from, either single family or multifamily, it's pretty apparent where the most potential is right now.
Here, I'm going to share my screen real quick. Now we're talking housing. A couple things. 3 different Bloomberg articles. New apartments at 50-year high may ease pressure on rents. So there's no doubt that we have responded to these demands. And I think there's the completions of houses and housing units are improving. We're getting some stuff done. Here we got U.S. new home sales plummet to lowest pace since 2016. And then cheap homes. This is kind of funny. Home sellers are slashing prices in pandemic boom towns. So, from these 3 articles, what I'm seeing is the plane has stopped climbing, and we may have rolled over a bit.
Yeah, and this kind of rolls into the next couple of slides, Mike, and that, where is the growth? Well, single family built for rent starts. You can see continue this, the one component of single family that continues to organically grow here is, the building of homes with the sole purpose of renting them out. You're not, the old thing was, let's build something and then flip it. No, the model now, especially for a lot of these big REITs out there, is let's build something to rent it out. And then that kind of shows up in the next chart where, and this is I highly recommend people follow John Burns Real Estate Consulting on LinkedIn. They put out a lot of great graphics and data-driven type analysis that's very visual. But single-family rental, same rent growth on renewal. So this is people staying in the same rental property. Look at the growth. Look at the cost to rent. This is somebody staying in the same rental property. Just look at the change from, just look at this organic growth, where even if you want to stay in the same property, you're going to pay substantially more. So you're seeing inflation in rent prices. And again, that dovetails back into, this is the obvious area where the multifamily are the beneficiaries, and then the single family, the shift away from people buying homes because they can't afford to do so with interest rates, with inflation, blah, blah, blah. But the big, conglomerates, the big REITs that have unlimited funds, absolutely, you're building to rent out here. This is the hot area going forward.
Yeah, for sure.
So let's jump into lumber now. Make sure I didn't miss a chart. So here's
You
the
know,
week. Yeah, I'm sorry.
let's before we do that, I just want to kind of we have all this news about housing and inflation, and it's all kind of basically has a negative twist, right? So what I want to show here is this is from timberonline.net, which is a European news aggregator about the timber industry. There was a survey, zero positive sentiment amongst the Austrian and German manufacturers of solid sawn timber. So where I'm going with this is when the news is out there, it's the known and people will react to it. So what you're seeing is, all of these basically sawmillers or, people that are in the timber industry over there, they don't think the industry moving forward is going to be good. So if you're an executive at a company and this is what your sentiment is, do you think your actions are going to be increase production or decrease production or, be ready to decrease? So I think it's important to take this information in and then think like one of those people. And, this is where you start to think ahead of the curve. You go, wow, maybe this is already built into the market. Maybe we could be at lows right now and we could see a rally. How can you get a rally in a negative sentiment market? Well, because everyone's reacting to what the data is. So it's kind of buy the rumor, sell the fact idea.
And I think we've seen that in full effect with the commodity funds building out their short positions, which we'll cover later here. But so just on a weekly continuation chart, we had a high last week in the 636 area. Reality set in Thursday afternoon with follow through Friday into yesterday, where the market corrected from that high of 636 down to the low in the 500 area yesterday. So you can kind of see this triangle, but a channel, kind of downsloping channel or funnel formation here, where until proven otherwise, you're probably in the scenario of lower highs and potentially lower lows until something changes fundamentally. Here's the September daily. It really didn't take much in the way of volume to kind of see this unravel. And now, you kind of fill these gaps back to the downside. Interestingly enough, with the spread, the rolls kind of in full effect right now, with the commodity fund rolls taking place out of September into November. September did not take out its recent low in this 470 area. November did in fact take out its low at 480. It made a low in the 478 area yesterday. So you did see lower lows in November, not in September. I think that's more spread driven, commodity fund driven, but that also could be an indicator that there's more bearish sentiment. Going back to that sentiment, there's more bearish sentiment the further you get into this quarter, into next quarter, especially once you get into the seasonality, the seasonal lows that lie ahead of October, November, where I think that there's this lack of sense of urgency, even in looking at, and I'll kind of come back to these, Mike, but I'll go to, here's our forward curve. Here's September, November, and then you kind of stair step up. But when you look at November, I mean, this is kind of a perfect visual description of what the seasonality of lumber looks like from a time frame standpoint. Typically, the market makes its low into October, November, and then you begin to stair step higher in anticipation of Q1 type needs. And that's what our futures curve is showing right now, where there's not a lot of confidence in the November time frame. As you start to shift gears out of this year into 2023, then you start to stair step higher and you get this cost of carry structure in these back months. But we'll go back here.
Actually jump back to that continuation chart. One thing, if everything stays the same right now, when that chart flips to the November contract, which it will once the November contract's open interest gains over September, you're going to have taken out those lows, right?
Yeah.
So you can actually see the future a little bit on that chart. If everything stays the same, that chart's going to look even more bearish when the November contract is what the data on there shows.
Yeah, you know what? And I didn't. Here's the other. Let me see if I can just drag this over here. I usually show this chart.
Oh, where the expirations were?
Yeah, here's expirations, but you're also in this pattern now of, we get an expiring contract at a premium to that next month out, and then there's this failure to go back and fill those gaps. We did it in May, we did it in July, and there's a likely scenario that you could conceivably, especially if that SEP NOV spread goes to some extreme level like 30, 40, 45 over, where you could have September trading at a sizable premium to November, and it makes it very difficult for that November to go back and fill the expiration gap in September. But that's the pattern in play, and obviously that's a bear market pattern. The inability to go back and fill these gaps is definitely an indication that you're in a bear market structure from a pricing standpoint, not just with housing, but also from a pricing standpoint. Let me drag that out of there. Let's see. So jumping back into, so here's historical, and thanks to Alex for putting these together at Stone. Here's historical September lumber closes going back to 2000.
Wow.
You can see even at $500, we're all kind of fixated on the big sell-off we've had year to date in lumber since peaking out in the spring. But historically, still speaking, if you're going to close somewhere in this 500 area, you're still going to have the second highest September close ever in the history of lumber. So let's pump the brakes that you can see just going back, throw out. And I know it's easier said than done, but throw out 2019, 2020. Or even throw out 2020 as your outlier. You can see that typically September goes off lower than what exists today, and then when you fast forward to November, same kind of thing. Where November, you've had some higher closes here in November, and I don't want to put the cart before the horse. November expiration is still a long ways off, but you can see, historically speaking, based upon November expirations, we're still relatively high when we look at 3-year, 5-year, 7-year average price levels versus today.
Yep.
Did I pass the?
Wow, you're really nerding out with us, histograms and everything.
Yeah, no, I thought this was good too. And again, thanks to Alex. But here's 1 year. You can see percent of days in these price bands. So September, only 6% of the time. So if you're just going to go on a 1 year historical basis, then September and November are the greatest buys in the world. When again, this is a 1 year. When you jump out to 3 years, okay, 50% of the time we're sub 550. 22% of the time we're greater than 550, less than 800. So the vast majority of the time is spent between 550 to 800 over the last 3 years. And then when you flip the switch to 5 years, this jumps up to 64% of the time, 19% of the time. So, the reality is the vast majority of the time over the last 5 years is spent at 550. You could make the case, you could take this 850 out and probably look at 650, 700. The vast majority of the time, probably somewhere in that 75% or greater of the time is spent 650 or lower in lumber futures. So this kind of puts everything into perspective that just how wild and crazy these days were, and the idea of returning back to normalization. And that seems to be where we're trending back to some more normalized type market structure. Here's your SEP NOV, and my opinion, and we'll see this in the CFTC numbers, there was some liquidation by the commodity funds on that push higher up to 600 plus. But to me, the vast majority of commodity funds are still short this market and will roll their shorts from September into November. And you can see this steady increase. So technically speaking, the next obvious area is this 30 to 35 over. And then above there, you jump up into the 40 to 45 over area. So that's still my upside target as we get through the end of this week into the first last 3 days of August next week, where this market, if all things kind of continue to trend in the same, all things being equal, we're likely to push out into this 30, 35 to 40 type area, and then we'll see do we belong there or not. And then when you flip the switch, here's July, September. Again, you're mimicking this pattern into July, September. Here's the end of, this is basically 2 days before the end of the month last June. So this would be for July expiration. You can see how it traded to 45 over. The vast majority of it was done in the 20, like probably 20, 22 area over. Those last couple of days, you had some, kind of a bigger push to 25 to 40, 45 over before you ultimately, the fund stop rolling and you collapse back in. But when I look at, I want to jump to open interest to kind of hit upon this point. So a week ago, Mike, we were 2380 down 46.
Yep.
You still had almost a 2-to-1 ratio of SEP contracts to November. Fast forward to yesterday, you're at that point now where November finally had its first volume day greater than September. And after today, the November contract will overtake September from an open interest standpoint. And you really haven't lost that much open interest week over week. And so the one thing I want to point out here, this is again my opinion, I think the fund rolls officially started yesterday. When you look at net change and SEP to NOV, and the vast majority of this open interest being in the form of spreads. I think there were 190 spreads that traded yesterday. This is what I'm looking for to tell me that the funds are taking whatever shorts they have in September and rolling them into November, more so than just that outright liquidation, where to me, the vast majority of whatever funds are left in September here are going to just systematically between now and to the end of the month get moved into November.
Yep.
And that's going to allow that spread to probably continue to push out. So going back to, from a basis standpoint, basis a week ago, we had convergence between cash and futures. Fast forward to this week, and with the sell-off in futures, now you have a pretty substantial basis developing in both SEP and NOV, where cash is trading $75 over September. Flip to November, you're almost at $100 discount in November or $100 premium in cash. So from a valuation standpoint, for those that are in the market, there's going to be a lot of frustration in having to buy cash at a premium to futures. For the forward type crowd, you're looking to buy the cheapest wood out there. The cheapest wood out there now is in lumber futures. Pure and simple, that's where your value is relative to SPF, relative to other species. And especially, this is the other thing we've talked about, but Southern Yellow Pine. This is Eastern Southern Yellow Pine. Western Central also have a very similar correlation. But for those Southern Yellow Pine jobbers that can species swap, I would definitely be, if I'm short jobs in Southern Yellow Pine and I don't have to cover in Southern Yellow Pine. Southern Yellow Pine, what I'm trying to say is Southern Yellow Pine is your worst possible buy right now.
It's expensive. It's so funny. I feel like we just yesterday we were saying pine's super cheap compared to everything else, and sure enough, that was in April. But it is flipped quite nicely there.
Yeah, so you're going to have to really have a justification to support the idea that, and again, this is pine 2x4s versus, again, that high correlation of taking pine 2x4s. There's an 80% correlation, historical correlation here versus lumber futures. But if I'm in the market, futures represents the best value right now. And that could be one of the other big reasons why you saw a bounce today, where you had some value seekers, some forward guys come in and look to get, cover shorts, cash shorts and futures at this big discount. And so Here's commodity CFTC numbers. We did have a liquidation, which isn't surprising, down 264. Longs also liquidated. You had a very minimal build with the commercial shorts here. Again, I don't think this gets liquidated down to some historically low number. I think that a big chunk of this is still, you're probably going to continue to see this move lower, but I think you're probably going to keep somewhere in the neighborhood of 650 to 850 of these shorts on, because I think the commodity funds are reading the headlines and bearish sentiment and have this big macro type picture when it comes to lumber futures. I don't think it's a flash in the pan type trade. They're more likely to stay in their shorts here, which again is good in going back to the spreads and helping to kind of understand the basis of where where value or where something is undervalued or overvalued when it comes to futures and physical cash.
It's going to be interesting to see all the shorts that are in Nove, what they do this fall. If that Jan or the Nove Jan spread gives them an opportunity to sell a little higher in Jan, do they continue to keep that short on, or do they finally cover and exit the market?
Well, and again, you will get to a saturation point to the downside in November. The one thing I've kind of echoed to my November shorts, if you have to stay in the market, then potentially look at selling out of the money puts to be long November 400 or lower. If you could get November, the equivalent of November put options, I'm short November in that 400 to 350 area. That's a pretty good strategy. Because again, the longer we stay down at these numbers or lower, I still fully expect to see more shutdown news out of British Columbia. And as long as there's difficulty getting logs, and I'm not seeing any signs of a big inventory or log build out in British Columbia, as long as there are log issues, you're likely to see continued curtailments in the West. I think it's less a function of pricing, more a function of logistical rail issues, logging issues, but I still think that's going to be the play where you see probably another 2 or 3 permanent shutdowns come out, temporary and ultimately permanent shutdowns that come out of BC, in the next, couple of weeks to couple of months to in the next 12 months to 18 months. The glide path out of BC is fixed now. You will see permanent board footage come out of BC and go everywhere else. Here's the mini contract. So this is total open interest is up to 111, September 41, November 70. So we're gradually starting to build on open interest and volume. And I think once September goes off the board, you're going to see this increase pretty dramatically.
I think so as well. They introduced the contract so late in the September cycle that there was no real incentive to even participate.
And I think that's kind of the mindset is let's get through September and then we'll fixate. We'll fixate on the new contract for November and beyond. The other thing.
Let's talk about the conversation spread info.
Yep. Oh yeah, there you go. The typo. Thank you. Yeah. You guys want, I like that. Thanks.
Let's have a conversation spread. Yeah. I'm going to be fascinated to see where this plays out, because to me, it seems high. I think over 100 seems really high for that, legacy contract versus the new contract, when there's so much optionality, meaning in the new contract, you have so many different species to choose from. You're going to pick the lowest common denominator out of all those species and deliveries.
And I think, Mike, that ultimately gets called out and narrows in once you engage other species traders into the futures market, where you have other producers outside of SPF, specifically Western SPF producers. Once you get the Eastern inclusion, once you get fur inclusion, then I think you're gonna float this back in. My guess is, somewhere in the 80 to 85, maybe a $90 area is probably fair market value for this the conversation spread and the conversion spread.
That Nove spread is bid currently. It's 101.5 bid.
Yeah, and then the other thing I wanted to point out, here's the legacy SEP Nove spread. At the time I took this snapshot, trading at 22.80. The high at this point was 23.20. This has since floated out to $25. Look, I understand that this is only one trade, but you can see the arbitrage here of SEPNOV, the mini contract, traded out to 27.30. So you had a $4 spread. So the people that are willing to kind of put the bid asks in the new contract, there are arbitrage, there are opportunities in both the outrights and spreads. I'm not going to say it's big volume, but for those that are willing to participate, you definitely see a little bit more volatility in this mini contract versus the legacy contract. And, if you're willing to take it, have orders in, you can take advantage of it.
Yep, for sure.
I think that was, that was it, Mike.
All right. So, my big takeaway here is it's a bearish sentiment, but everybody knows it. So, the thing that gets you, so to speak, is the unknown. The known is that it's bearish. So, what's the unknown going to be? You're bringing up some good points today about the political environment in the United States with elections coming up. And then you also, obviously, the global geopolitical environment with the Ukraine war and inflation. I like to call it artificial inflation because it's induced by a factor that doesn't really have anything to do with actual economic reasons. The gas situation over in Germany.
Yeah.
But it's the unknown that we need to tease out of this. You drill down to lumber. The known is that the funds are short and the industry's long. Who's going to be right? It'll be interesting moving forward. And I agree with you with regards to the new mini contract. I think you'll see an uptick in volume starting after the September 15th. Well, actually after Labor Day.
Yeah, and my only all great points. The only thing I'll add is run your own business. Don't assume the industry's risk. Look at your own business, and understand basis can work in your favor, not just for SPF but for all species. And at least have an idea of what's overvalued, undervalued, and utilize that to your advantage.
All right, we're getting the hook from Tim Hansen off the stage. He says, let's wrap this up. Futures are falling the longer you talk. Sorry, Tim. I hope you're not long.
Yeah.
All right, gents. We'll check in with you guys next week. And as always, if you have any questions, let us know. If you have any comments, stuff you'd like us to show you, let us know. But in the meantime, be safe and have a great week.
Yeah. Thanks, Mike. Thanks, everybody. Have a great week. Take care.
Take care, Greg.